Well, guys, this is going to be a bit of a different one. It's going to be a technical one, and the theme of this video, which is really how we've understood that markets were going down since 44K, and it was quite late on we cottoned onto this, is the fact that the Fed are going to destroy you. Now, that's meant to be a bit overdramatic, because essentially what the Fed are doing has always had huge implications and ramifications in regards to markets before crypto was even a thing. And the cryptocurrency market finds itself in this kind of macroeconomic hurt locker. And it's going to get worse. And I'm going to be showing you that. And we're also going to be looking at the fact that everybody's looking for a pivot, but I'm going to show you what actually happens when a pivot comes, because usually a pivot has always came off the back end of something going seriously wrong. We spoke about this Lehman's moment that we're waiting for in the crypto market, but markets across the board. We do so much cross analysis. We've looked at the dollar, falling wedge, breaking out, looked at its pairs. We've looked at the S&P, which, yes, there was always 2 weeks ago, we looked at Mike Wilson's comments and said, look, this is it for the S&P essentially. And we still haven't touched any investments yet, despite every single relief rally that we've had having huge amounts of sort of retail FOMO around it and the narrative really shifting. And it's been really because the reason, or it's been mainly because of the reasoning that we've been watching the Fed and what they are doing, because it's so obvious, you know. They printed $7 trillion. Now, that found its way into asset classes from obviously the March 2020 crash onwards. However, if you look at the interest rate that we currently have and the amount of debt that's out there, the majority of that $7 trillion that has gone into markets now has to go into paying that debt off and the sort of federal debt, corporate debt in the United States. But even in places like, you know, we had the ECB rate hike and the Bank of England rate hike yesterday. They're all doing the same thing, and it's all taking money from markets and having to put it elsewhere. And they're doing this as a kind of way, like it's almost like a shock collar. They're doing it to essentially shock the markets in terms of demand and take that money out of the markets, take the heat out of inflation is why they're doing it. But is it? I've always had this feeling, and we're going to get into it. We're going to look at the Fed funds rate. We're going to look at this. I've always had this feeling that the Fed can't be that stupid to just play with people's lives like this, whether it be through printing the $7 trillion or whether it be through what they're doing now. You know, they can't be that dumb where this has just happened by accident, when the reality is everyday people, like including myself, although we are active investors, so we can sort of mitigate this a lot better than normal people who don't perhaps look at it all the time. I can't help but feel like maybe there's something a little bit more planned behind that in terms of leveraging everybody up and then taking it away from them and then rinsing and repeating. But we will talk about that all in this video. So we are going to look at Bitcoin. I want to start with this. And this is the Fed funds rate, and this is the 2-year Treasury note yield. So this is interesting because the 2-year yield will obviously lead the interest rate rise. So the 2-year yield is obviously a debt instrument. It's a bond, essentially. And what this is predicting is that something bad is about to happen. We're about to have that Lehman's moment pretty damn soon. Now, I'm going to do an extended video for my Patreons on this. So anybody that's interested in joining, please check the link in the description. But the Fed have always, so this is suggesting that this is not too far away at all, their pivot. But the interesting thing with a pivot, everybody, and we'll use the S&P to demonstrate this, everybody is looking for a pivot to flip bullish. Well, it depends what the reasoning. Remember, we were looking at the S&P, looking at this trend line. On this candle here, we were essentially saying, look, it's probably time to avoid. Markets love to do this. They love to go and put in a marginally higher high. You'll see this as a trader and an investor all the time. Before then, you know, tricking people, making these guys a little bit nervous, and then it will basically send it in the direction it's supposed to go, which is the down direction based on everything that we've been looking at. So let's pull up the Fed's funds rate. In fact, let's just add it to the S&P. Let's get a broader chart and let's make sure it's clean. So we're going to pull up the Fed. It's all one word. The Fed's funds effective rate. Okay. Now, what we're going to look at, so this is when interest rates are going up, right? Every time this has happened, usually they've had to stop because something breaks. So yeah, we had the Lehman's moment in 2008, which was the great financial crisis, although this one's going to be even bigger because it's global. You know, if you look at 2008, actually large parts of Asia were not affected. Australia wasn't doing too badly off the back end of it. Yeah, there was some sort of mitigation. But this is the Fed funds going up. So interest rates increasing. Let's look at all the times that they've pivoted, which is what you YouTubers are all screaming for. You've got to be. It's not as easy. Investing is not that easy, guys. It is relatively easy on the bigger time frames, but it's not as easy as people make out. So they pivoted in 2007 so they reduced interest rates into what was an awful moment. They kind of had to do this. Had the dot-com boom and bust, which was very similar. So they had to, because of the way the economy was going, bring rates down, and it wasn't really until rates were at a low point that the market started to rally again. So this is kind of what we're looking at. See, low point, markets rally again. So the Fed are going to have to not only pivot, but come in and stimulate before we get bullish again. So we're not just one of these people that go, oh, pivot, we'll be in there. Because what happens if they're pivoting because there's a SHIT storm that you're caught in, whether that be March 2020, whether that be 2008, whether that be the dot-com boom and bust, you know, and actually there's not too much of a dissimilar trend the whole way along. So the Federal Reserve, the central banks were essentially introduced in the name of stability. However, what they actually have always done is created volatility in terms of in dollar denominated that we've never seen, because the whole fiat system is expandatory by nature, because it has to be, because it's an inflationary system. So what we're essentially calling for is this crash to not be too far along whatsoever. And I'm going to pull up the yield curve. It's also meant that there's been a yield curve pretty much every time that the Fed have done what they've done. The last one was the precursor to March 2020, which was when the repo market, of course, clogged up, basically, for lack of a better term. Repo market is kind of like how intrabanks lend to one another. You know, you got your four big banks, I think, that make it up in the United States. And there was a real issue here. And look at this yield curve. This is the steepest one that we've had out of all of these. And there is a steeper one, I think, going back quite a few years. But, you know, to compare them in terms of the economy is insane. So we are literally expecting the Fed is going to hold their foot on the gas for longer until they have to pivot. They need a reason to pivot. Otherwise, they are not going to with this kind of inflation. Are the Fed going to pivot with 7.1% inflation? Their target is 2. What have they said? Continuously. I don't know how people get wish-washed in terms of an investment point of view. Trading, I understand, because it's a totally different ballgame when you're trading on small time frames and you intraday. Investing, the picture has been as clear as day, guys. And we have given you that picture on this channel. And we're still giving you the sort of road ahead, which I believe is a pretty nasty one. I think something serious is going to go wrong in terms of markets. It could be geopolitical. Who knows what it will be? But it's being foretold. That's what we do know. And it is coming. And BlackRock were essentially predicting a fall in GDP by about 2.1%. That is massive to get back to our inflationary levels. So a deflationary event, like a big event, like March 2020, would cause inflation to lower. You know, maybe this is what they're trying to usher in or cause. It's just a lot of the warning signs are already here in regards to the Fed essentially going too harsh on markets. So let's talk about Bitcoin. You know, we highlighted on the daily. It's now on the weekly. I mean, that's a shooting star if ever I've seen one. This shooting star yesterday, we'd said actually going way, way, way back. I'll see if I can pull my account up. that very common when you do this sort of a rising wedge scenario, that you trick everybody and break out the top of it. Markets I've read so many technical analysis books that are sort of before the generation we're in terms of markets. I think largely, yes, trend lines and stuff like that are still very much the same in how they act. But in terms of market movements, it's very different, and it's more designed now to actually go against retail, but go against the retail with smart money to the point where it can take it out. So it's very common, and we were highlighting this rising wedge. It's very common that you do this, and this has always been the way that we've trajected this. Let's take a look at Bitcoin. I mean, am I good or what, guys? I don't know. That's not for me to say. That's for you guys to say. It's obvious. But I'm here to definitely tell you this is a bit more of a sobering one, because at this point, it's not long before something goes seriously wrong and breaks. China's reopening. The US are throwing harsher sanctions on there. The Russia-Ukraine situation, nobody really knows what the hell's going on in that one. This is all going to come to a head, and that's geopolitical. Forget the economic internal reasons for damage. The ECB signaled another 350. That's pretty unheard of for the ECB, and the amount of debt that those guys have, and the amount of countries they have involved that all have their own specific needs and their own sort of financial situations. That's going to cause something to break pretty imminently, and the dollar, whilst this has now started its leg lower. Okay, that is going to make no sense to anyone. That's obviously something I've been playing with. This is what you got for the dollar. Squeezy, squeezy, breaky, breaky, up. It's going to reassert. It's my opinion that the dollar goes on and puts in new all-time highs. What else am I going to show you? I was going to show you something else there that sort of validates this. It's the GDP, Great British Pound, or dollar, Great British Pound. Similar thing going on. So dollar looks like it's about to reassert. This is all coming to a head, in my opinion. What do we think for Bitcoin on the daily? We've been sort of taking a little bit of a step back from day trading and really trying to. When you're day trading in these kind of 5-minute time frames, you don't have, you might have the overall trend, but the market doesn't move like that on the small time frames. It will take liquidity to both the up and the downside, so you need technical structure to trade off, signals, if you will, that aren't paid for, anything like that. You need to be able to work this market out and look for certain signs and patterns in the charts that repeat in order to trade this, which is something that I'm working on pretty aggressively at the moment, or refining, I should say. So that's all I've got for you in this video, guys. It just looks like it's going to be a pretty bleak one. Gold is massively, the UK 100 is massively down. Stock market's down. We'll see what happens. Could be a bit of a soft Friday, but then maybe going into Sunday, we could see that further continuation to the downside. All I've got for you in this video, guys. You enjoyed the content, like us, appreciate it, as a comment. I look forward to seeing each and every one of you in the next YouTube video. Thanks a lot for watching, guys.